thanks everyone for joining today. Just a little bit of background. So Matt here started his career in quality and lean manufacturing, then moving into procurement and quality leadership roles before founding K2 Sourcing in 2003. So since 2003, he's overseen more than $10 billion in spend with over $1 billion in savings. Served as president of ISM Milwaukee, earned a lot of significant recognition from organizations and companies like Gartner, Supply and Demand Chain Executive, Spend Matters, and ISM as a leader in procurement and supply chain. So, again, thanks everyone for hopping on. We're super excited to get the conversation going today, and I will pass it on over to you, Matt.
All right. Thank you, Melissa, for that introduction. And hey, thank you, everybody, for your time today. So, watching this webinar about economics for procurement. I know it's everybody's favorite topic, but really, I've been doing this for 22 plus years and posting weekly comments. And a lot of the leaders I talk to, which are a couple hundred people a year that I stay in touch with, said, hey, why don't you start running these more as a webinar where we could all chat together and do things like that? So at the beginning of the year, we said, yeah, let's go ahead. Let's take some of these major trends that are coming with the shift in leadership in the US and talk about a little bit. During that, we asked the group, hey, if that was valuable, do you want us to come back? And resoundingly, everybody said yes. You know, there were 60, 70 people in there. In the second one, we had about 100 on between LinkedIn and here and said, yeah, we'll do this again. So again, a little bit different with K2 being than an advisory firm. I will give you my opinion and predictions. People know that. Will say a number and I don't really hedge. I'll tell you what I think it is. That being said, look, it's based on 30 years of experience, thousands of global sourcing events that our company has done. But at the same time, it is a forecast. It is a prediction. It's not to be taken as a fact or a recommendation. So with that disclaimer, my first prediction I said is, do you remember when we had, and in the first, let me see, is this showing the poll? No. Okay, let me
No.
launch the poll. All right, let me get this poll up.
Now it's up. Yep.
Okay, here's a quick poll for you guys. In the first webinar that we did in January, I stated that we talked about Smoot-Hartley changing tariffs to around 59% back in the 30s, which caused a global recession. And a lot of people think is responsible for the Great Depression in the US. And I said, look, I don't think we're going down that route. Okay. However, I did say the lesson we really learned from that was also about how much supply chain was disrupted. So we've got 1-for-1 vote at 11 to 15%. The reason why I talked about that prediction saying supply chain is disrupted is exactly the figure I'm going to give you now. How much is the decline in imports from China to the US from 2024 to 2025? In 2024, all right, we're all sticking in that 11 to 15% range. Is this coming up on a chat, a Google chat or something? Okay, we got 16 to 20. Love it. Okay. All right. Well, let me give you what that correct answer is. In 2024, we had $439 billion of imports from China into the US. In 2023, it was 423 billion. So it actually increased last year. This year, even with people pulling in, remember the tariffs, remember people pulling in shipments, we are on track for about $330 billion this year. It's just under a 25% decrease in 1 year. So if that doesn't tell you that supply chains are moving quickly, well, I don't know what would. So let's talk about that today. We're going to talk about what is actually driving those changes, right? And how it's going to impact you. So first, I'm going to talk about tariffs and trade. Then I'll talk about immigration and deportation, energy policy, and finally the impact of the One Big Beautiful Bill Act. That's the OBBA there. That's what that stands for. We'll bring that up and show you holistically what that model looks like. And then talk about actions to maximize your supply chain value and what you need to be doing over the next short-term year to handle these different factors in long term. Okay. If you have questions, go ahead, chat. I think chat should be on. If not, the Q&A is on. Melissa's keeping an eye on it. She'll let me know.
Yep.
I answer them as I go. But if I miss it, then we'll get them at the end for sure. There's plenty of time. Again, Melissa gave a great introduction, but to understand, yes, I do run K2 sourcing. We have a pretty sizable team here, about 20 people that we work with on any given day. So, but I am a procurement focused niche leader, right? That's what we do is we work in procurement, and that's really what I've done my whole life. And at the end of the day, what it comes down to is really applying that knowledge to help other people. That's what we enjoy doing. That's why we're doing this webinar, because I literally spend 2-3 hours a week studying geopolitics and economics. I'm actually one of those weird people that like it. So why not share it with other folks? Hopefully you get some value out of it, and it helps you out. So one of the things we're going to do today, again, is talk about those different factors. And who couldn't say, who would disagree if we said tariffs has been the headline for the year, right? It's been taking procurement people every direction. And right now, what we see is the average effective tariff rate being about 17.4%. What do I mean by an average effective tariff rate? An average effective tariff rate is the dollar value of the imports coming in, and then you divide into that the amount that was charged for tariffs, and you come up with your average effective tariff rate based on current policy. Okay, so right now you're looking at the average effective tariff rate of Mexico 7.9, Canada 6.9, China 27.9, and all other countries 15.6. Now you say that's kind of interesting, right? Because the current policy on China is 55. That doesn't mean everything is tariffed and things are tariffed differently, right? That's why it's a weighted average. Same thing with Canada and Mexico. We know the numbers are heavier, right? I mean, 50% on steel and aluminum on some of this stuff on metals, but yet 85% of stuff coming through Mexico and Canada is still coming through at a zero tariff. So we have to look at this as a weighted average to get a good number, and that's what you're seeing here. These are recent figures that have been updated as of September 5th. So pretty recent. Now, what I said, originally what was interesting on my predictions, right? I said it would be, Trump had stated a 21% agenda is what he was coming out with at the end of the day. That was his announced plan. My prediction, I said by the end of the year, we're going to hit about 10%. Now, when you look, you say Mexico 7.9. I said we're going to be 5. Canada 6.9. I said 5. Hey, pretty accurate. China, I said 20, 27.9. Hey, not bad for a forecast. If your salespeople hit that forecast, your operations would probably be a lot easier to manage, right? It'd be a pretty good number. Okay, so what was my big miss? I really blew it on all other countries, to be honest with you. When we really discussed this in January, really felt that in discussions I was having that we were trying to surround or isolate, maybe is a better word, isolate China, right? And we wanted to pull out of China. That's happening. You're seeing that. But at the same time, we're going to build allies around China, maybe with some of our other key trading partners, like you'd think like India, who is really in the best position to take up a lot of that manufacturing with that labor force. We did not do that. So that surprised me a little bit, that he came out and just said, no, we're going after tariffs with everybody. So that's the reason for the miss there in the adjustment in the model in total, that I had to go up from 10 to now this 17%. That being said, going forward, I think we are starting to land on a lot of different deals right now, even though they're pretty hazy what those actual deals are. I think people are starting to feel like this is where it's going to shake out, or at least pretty close to 15% on these guys. Maybe again, I'm going to stick with my 5 on Mexico, Canada, and China. That's an interesting one. I think we're about where we're going to be with them. Okay, so plan accordingly. Where do you see that? How does that impact specific commodities? Obviously, it's going to have impacts huge on the largest consumer products, but also on metals, because metal is also getting hit again, with those additional tariffs. So I won't go through all these, but it's not surprising. You're going to see a lot of impact on the electronics, leather products, although they backed off on some electronics. Some machinery is big, right? But these are your top impacts that you can look at that are impacting everything right now. Again, I won't go through all of these different tariff impacts. Again, these are based on what people are actually paying and able to sneak in and do all kinds of different stuff. This source is actually from the Yale budget review that I grabbed this from, and I can share that source with you later. This is not something I created. This is from the Yale budget review and what people actually paid and are going to be paying in the short term globally. Okay, it's across all countries, by the way. The big discussion we're hearing out here right now, right? We can't get past the tariff discussion in the news. It's every single day we're hearing something about tariffs, and we're hearing it. How is it going to impact? How is it going to impact inflation? And originally, when you look at what we talk about the tariffs overall impact, we really see that, typically, right? The tariffs we were projecting maybe 1 to 2, maybe tops 3%. If everything Trump said, you were talking about maybe a 3% increase, maybe one-time hit to inflation over the next year. We really didn't see it. A lot of people forward bought. And now everybody, the headlines are all, is that forward buy ending, right? Because what happened? Well, one, we saw a big PPI, that's producer price index, increased. We saw consumer price increase. Now it's smaller, but we're seeing them trending up, right? And that PPI, what producers pay, businesses selling to businesses, that's a shortcut way to say PPI if you want to define that. While we're seeing that trend up, right, that eventually has to get pushed back to consumers, or somebody has to pay for it. And when we look at the impact of tariffs, you go, well, maybe it's the suppliers eating it. Well, is it the suppliers eating it? In the last 12 months through July, import prices are down 0.2%. So maybe a little bit they're taking some of the tariffs on, but a lot of it they're not. So again, purchasing's doing its thing. We're moving products around, pulling them out of China, trying to figure out how do we make this cost neutral or find our good PPV, right? In the midst of all this other. So some of it suppliers are eating a little bit. Some of it was forward bought inventory that's probably now running out, that's starting to pull through PPI. And a lot of people see it in the starting to come through CPI. But let's see where that goes as we go forward here. But I think we can sit in this projection that this PPI is going to sit in this 3.5 to 4 range pretty much. But the other important thing to understand is not to look at just the headline number, because a lot of it, right, a lot of that came through on services. So if you just look at the headline number, you go, oh, it's all the tariffs, right? That's what the news wants to say. But you look at it and you go, wait a second, well, tariffs aren't really affecting services. So how do we shift? Is that the impact of immigration and deportation? Maybe. Remember what I talked about in January? I said, look, for about we had about 1.3 million workers was kind of a projection that people thought they were going to try and deport this year. And the estimates from all the economic institutes said that would probably could translate into about 1.3% inflation, with obviously different industries being impacted very, very differently, right? I mean, just the other day, I saw an article about a California farm that lost a lot of immigrant workers that were removed from the U.S. and their prices went up 20% overnight. I don't know if they had to get temp labor or how they dealt with it. One of my buddies in procurement, who's might be on here, talked about a warehouse this just happened to down south, right? And now they had to replace all that labor with temp labor, very expensive overnight, 200 workers. So you're seeing these stories, these case studies where costs went way up really fast. But in the aggregate, when we look at pulling out 1.3 workers, we're probably talking about 1.3%. So where are we at today? I originally said, yeah, they sound aggressive. They're going to go for 1 million people this year. And that's what I based my original forecast on and used that 1.3%. However, we're talking about the deportations, maybe 400,000 people right now. It depends on how these numbers are really hard to track, right? You have the recorded ones that the government records, but then you have a lot of people that leave voluntarily or just don't come anymore. We know that immigration is slowed to a trickle. We know some people have left, but so really a lot of the estimates, if you look, they're saying about 400,000 people. So far short of that million they were looking to do, really far short, right? Um, so what's interesting when you look at that impact, I backed off. I'm saying no, 0.75%, 0.5% inflationary charges over the next year because of wage inflation. Where does that hit you in procurement? Well, if we're reshoring, right, we don't have enough labor. Well, then prices go up for wages flow through into prices. We pay more in the US for those different goods and services that we're buying, whether that's facilities maintenance, professional services, etc. And again, that's where you've seen it, right? It's actually in the services, hospitality, and believe it or not, a lot of professional services as folks are getting a little concerned there as well. What was interesting is, when I saw this quote, I follow Moody's, I listen to their podcast, and Mark Zandi's out all over the place, their chief economist, saying, hey, it's going to be 4% next year. But I really need to send him some texts or some emails because I just don't see how he's getting there on the numbers on this one, and they're not explaining it really well. Because when you look at the impact of 400,000 people, again, I'd be thinking it'd be about 0.5% to 0.75. 400,000 people on America's labor force of over 100 million is not a lot of people. Okay. So the fact is, it's a small percentage leaving right now. We are seeing some, and again, there could be sectors that will be hit pretty hard. Um, that being said, service sector, we talked about, increased quite a bit more on the CPI. But then if you dig in even deeper and saying, why is it wage in price? Well, not really. We're at 3.7%, which is kind of normal. It lagged behind inflation a little bit. Wage inflation is coming back, but it's certainly not out of alignment with where we think, in the fours and the fives in true scary labor shortages, right? That you had when COVID was coming back. You see people getting huge wages, right? So if you dig in, it's mostly due to housing costs and financial services like insurance. As car prices go up, why are car prices going up? We know why, because of steel and all the import costs. Then insurance costs go up to support your car. So really, when you start to dig in, you go, well, I'm not really seeing it yet. So I've revised my impact down to, I guess I said 0.75. I revised it down to about a 1% impact over the next 12 months versus the previous 1.5. So I don't think wages are going to play a huge role over the next year. Policy, energy policy does. I always think this is pretty interesting because of the big changes we've made in policy this year. Kind of feel like they'd be a little net neutral now. People can argue whether they like them or not. We got rid of all the subsidies on renewables, which therefore would reduce different streams of energy and maybe less competition and create some cost increases. But what they did is they replaced those and moved the tax incentives or subsidies, if you want to call them, to fossil fuel companies to expand, right? I mean, I don't think anybody was surprised. I mean, half of Trump's program kept saying drill, baby, drill. I think that quote was out there a million times. So he followed through on that. And the one twist that he did that I thought was really interesting was in a lot of the tariff deals he made, especially with the EU and Japan, he really wants them to buy much less, right, from who, and buy a lot more from America. And they are. A lot of people think that's going to double our exports to liquid natural gas. And look what's happened. I forecasted 14% at the beginning of the year increase. We're at 13.8% right now. So, if you look at that increase, it was right on target. If you look at it, electricity, we're up about 5.5. And here's where I did get it wrong. Actually, I said, usually a lot of this natural gas is a big input into some of the different resins, and a lot of that would pass through in the broader economic plastics market, but it really didn't translate that much. I know, of course, they're always trying to push through, but really not seeing giant increases. At least I haven't seen that in resins and been able to push them back to the manufacturer because of weak demand. So the energy impact overall, I do think is huge. In most corporations, their cost of energy, gas and electricity, is usually about 2% of overall revenue. So it's a big number, right? Then if you take that and you weight that and say a heavy manufacturer is going to try to use more natural gas, especially up here in the Midwest, versus electricity, you come out to about a balanced 10% that's passing through. So a 10% cost increase on 2% on $100 million company, it's not insignificant dollars there impacting the bottom line. And I'm going to show you how that fits into the total model at the end of this. Okay. But so understand that energy was kind of movement from one type of energy to another type of energy. What's driving the cost on gas is certainly that additional exporting that's being pushed, demand side economics. Okay. So let's talk about tax regulations. The One Big Beautiful Bill Act. I love to say Bill Act. They left the bill name on there as part of the act. So really, to be honest, a lot of the tax policy, right, it maintained the tax cuts that were from 2017. It wasn't the additional deduction that Trump proposed during his campaign of getting to 15%. This is staying at 21% rather than having to go up to 26 or 27% it was prior to 2017. Okay. So it did extend all those 100% deductions. And it really was designed to spur manufacturing increase in manufacturing growth. That's what this whole thing was all about, right? So on one hand, you have those tariff sticks saying, hey, we bring it back to, we want you procurement people to source this in the US, and we're going to make it hard for you not to some extent, while trying to manage the inflationary impact. And at the same time, we're going to get all these deductions so that there's massive investment in US capacity to do that, to support that comeback, if you will. Now, what's the economic reality? Maybe I'll go back here and leave it on this slide while I talk about this for a little bit. Let me give you some statistics that I wrote down. Any of you following the jobs report, wow, people were freaking out, right? The numbers aren't good. Manufacturing, it's worse, right? 78,000 jobs lost in the last 4 months. The ISM PMI remained in contraction again. We've had almost no growth in the last 2 years of manufacturing. So when you look at that, you say, okay, we haven't had a lot of growth. Capital equipment expense and CapEx is coming back. It's sitting at 4%. It's pretty good. It's pretty healthy, actually. So people are starting to invest in capacity. But what's interesting is you go, okay, we've got these tariffs. We've got this subsidies and incentives to build capacity in the US. How has reshoring changed? I told you at the beginning of this, out of China's 25%. But how much has manufacturing output increased? It's flat. Again, there's no jobs, new orders down, maybe 1% higher capacity in some reports. I saw that industrial capacity in the United States is actually 0.1% higher than it was a year ago. So I'm going to say this. We spend a lot of time helping companies reshore at K2 sourcing. In the last few months, we've been able to help people bring back some aluminum die casting. We've helped companies bring back some injection molded parts. We've helped them bring back some machining, some good core stuff back to the US. But here's the deal, it's really, really selective, right? And while a lot of that stuff is coming out of China, you've probably seen some of my other posts who the big winners are. And you can guess who they are. They're the other APAC regions, right? Vietnam, Thailand, India. Those are the other countries, Mexico, certainly other countries winning the business. And it's not the US, even though we put in these incentives. So will that turn around? Um, I don't know. I think we're seeing CEOs are at an all-time high, even higher than they were a year ago, touting the benefits of reshoring. And certainly the reshoring organization would hate what I'm saying today. They have all kinds of numbers about hundreds of thousands of jobs created in manufacturing due to reshoring. But when I look at the big numbers, the import dollars versus well, really the import dollars versus production, I'm just really not seeing a huge spur in manufacturing yet. Again, companies are investing a little bit more in capex, so maybe they're getting ready for it. As we land into more clarity, I think you'll start to see more changes. Now, I should have asked for another poll question here. I don't know if I could create one on the fly, but how many people think that that corporate campaign promise of 15% is really, really likely? And why is that important? Well, because the environment we're talking about right now is getting a little sketchy, right? People are starting to pull back, seeing that inflation, seeing that PPI, seeing the services spend go down last month, even though consumer spending overall is healthy. There is some pullbacks if you look in there a little deeper. Um, so the other part of this bill, right, we talked about was more personal income tax deductions. There's a lot more there in terms of the new SALT deduction and some other minimum deductions that translate into real money for a lot of people next year. And I think they're hoping people will spend it. At the end of the day, I think, I hate to say it, but if I switch back to my model, I go, well, remember when I modeled this the first time for you and I said, what are the impact of tariffs, energy, immigration, and tax policy, right? Those are the big things we're talking about, right? Right here. What is the impact of that when we look at it? Well, here's our baseline where we started from at the beginning of the year before any policy changes. And I said the stock price would end up at 170 at the baseline. And in my original predictions, I should have brought that up with me, but I basically said, look, it's a wash to maybe 171, 172 based on these policies because of the different tax rate deductions and how tariffs are going to play out. When I reanalyze it now, when I sit at this 21% tax rate, put in the tariff adjustments, the energy adjustments, pull out the labor costs, I am giving the tax benefit here a little bit. Of some of this other stuff that we're seeing. But stock prices go down, which seems strange for this administration. So how do they get them back up? Are they banking on a huge tax rate decrease, right? Would that pull it back up? That pulls that stock price back up. It's just not significant enough with all this other stuff going on to pull this back up. So what could they be betting on? Usually, they're betting on growth, right? So a lot of times when government entities, when politicians discuss tax rate cuts, it is a stimulus to the economy. And there's truth to that, right? There's more money that is going to go to the private sector rather than the public sector. So it tends to have a stimulating effect. But the question is, how much do we got to get just to break even? Well, 8% GDP growth to get to 170. Anybody see that happening with massive inflation? I don't know. If they get their tax cut rate, maybe growth holding all things constant to get to 170. No, you got to get a little higher than that. what was that number? Maybe a 5? Yeah, we got to go up to 5%. So even if they got these massive tax cuts through, you're still at a 5 to 8% growth rate to come back up to these stock prices. So I'm that's one of the things where I'm questioning my predictions and why my original predictions were a little bit softer on some of the tariffs because this administration tends to be pretty pro stock market, right? Anytime there's a jitter, he's like, oh, let's do this. So I was kind of going by that. But then I had to look back, and one of my buddies, Tom, and I, COO locally here, had that discussion. Well, you look at 2017 and you look at now, and all Trump talked about his whole career was tariffs, 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 tariffs. Maybe he was serious this time. He really thinks that's going to save us. So that's where I'm a little torn right now. I've given you what my predictions overall, when you put that all together, that it is going to be, at the end of the day, my conclusion is, wow, surprise, surprise, more headwinds for procurement, right? I mean, it's been the toughest decade ever for procurement, and I don't see it getting that much easier. I think we're going to get a little more clarity around tariffs. Obviously, you can see we've already have um, a lot of deals. I know they're not super clear yet reached, but getting close is a way to say it. Um, but I think that the economic uncertainty as some of the stuff starts to roll out, businesses know where to go, what to invest in, and what to do. So we're going to start being able to move forward. I think, again, it doesn't change then a lot of the different factors here, understanding the total unit cost so you can react very, very quickly to where you need to be. And as part of that, why do you want to do that now? Again, because you have to understand the utilization rates. Right now, North America utilization rates, I think I just looked, we're at about 75 or 77%. 84% is where you start getting into an inflationary environment. So the America can grab about 7% more business in its manufacturing before we start seeing really heavy demand side inflation, right? So if all this reshoring hit all at once, certainly it would blow up. There'd be massive wage inflation. There wouldn't be capacity. It'd be a mess, right? So you really have to keep your eye on that to make sure that it's not expanding too quickly. Same thing with our friends in the near shore here, Mexico and Canada. At the same time, we do need to plan for long-term inflation. One of the things we didn't talk about too much in the last time is that deficit-driven inflation. One, deficits not only create inflation through the weaker dollar. There's a lot of institutes like Goldman Sachs, some of the other large industries saying they could see up to 10% weaker dollar next year. I think we're already like 5% this year. So a 10% weaker dollar, that's 10% negative PPV on your imports. Wow. Talk about adding more to that tariff chart. Man, throw another 10 points on top of this. That is a big number, folks. So I think one of the things we really got to keep an eye on is this weaker dollar as people get concerned with our spending and how that works. And of course, the whole news is stagflation right now. I don't know. Let's see how that fits in. It feels like that a little bit right now, as employment is kind of frozen. We're seeing some inflation. Is it going to turn into a real problem stagflation, or, with the stimulus coming in from the high government spending, and is the Fed going to do something differently now in September? A lot of people think so. We could go all day if there's going to be stimulus here, but my guess is probably, so where is that going to land? I don't know, but probably some inflation in there. At the end of the day, any type of stimulus, right, is going to add to our inflation issues most likely. So inflation is going to be the thing we fight. Weak dollar inflation as well. And of course, we have to continue to keep our eye on geopolitical conflicts. Those are probably the big things that I can think of right now to watch for. But if you have any questions, happy to field them. And again, if you like this type of information, happy to do this. We'll probably do this again somewhere towards the beginning or first quarter of next year to see how things roll out as midterm elections start to come up. And I think there's some other pressures uh, politically that come out that will change policy. But hey, if you like the stuff, I post weekly, um, all kinds of stuff like this. Follow us on K2 Source and on LinkedIn. And please, if you like it, get engaged in the conversation. And the biggest compliment you can ever give me is to forward this information to other folks in your network and help get the word out about procurement. So with that, let's see. Hopefully I had questions on. Did we get any questions, or does anybody have any questions or any chat that they want to talk about right now? Or is it just too many numbers and you're like, wow?
I would suggest using the Q&A tab if there's any questions. The Q&A tab is the best spot for that.
If I pull up the Q&A, can everybody see it, or do you see the Q&A tab when I bring it up or no?
We don't see the Q&A tab, but if
Oh,
when we start getting some questions in, we'll be able to see them behind the scenes. Okay, I think I do see one question. Kind of talking about the big, beautiful bill again. Let me see here. Do you, oh, hold on one second. Okay, there it is. Do you see it accelerating or slowing down investments in supply chain capacity? How do you expect it to influence investment decisions going into next year?
okay. I have different questions. um, okay, well, I'll go with the
There's another one too, if you see that one on top.
interesting. Okay. Um, Okay, well, I'll just start answering them as I see them. I feel like I'm missing one here, as you said, but I'll catch it. All right, do you see tariffs becoming a long-term factor or just short-term? Yes, I think I think tariffs are long-term, right? They started being enacted in 2017 under Trump. It was very popular with American voters. So then the Democrats jumped in and said, yeah, let's do tariffs as well. Biden increased all the tariffs. Trump's in, increasing them again. So I see tariffs as very long term. And again, I adjusted my forecast up from an average tariff of 10% to where I sit now, about 18% long term. So, yes, you absolutely have to consider them during your long term contracts. The how, well, that's a little more interesting because remember, um, tariffs are a one time hit on price, right? Tariffs don't, it's not like inflation, it doesn't go up every year. Tariffs create inflation the minute they're put in. If I pay a buck for something, I now pay a buck 10. It's not going to change to a buck 20 unless the tariffs would go up again, if that makes any sense. So it's kind of a one time hit. So how you handle that in contracts is a little, might be indexed a little differently. Hopefully that answered that, but feel free to type follow-up questions if I wasn't quite clear. The BBB accelerating or slowing investment in supply chain capacity. I love this question because the whole damn thing was designed to spur investment. We've seen investment in the CHIPS Act, right? We've seen lots of capacity being expanded through the CHIPS Act. We've seen CapEx starting to grow here a little bit. So I guess my short answer is yes. I think we're definitely going to see companies investing more in automation, particularly, and looking for jobs where they can. And what I mean looking for jobs, looking for work from procurement folks and other manufacturers where they can use automation, um, where they can use automation in their operations because of we're deporting labor that we could use, but even with that labor leaving again, what we're really lacking is the skilled trades, and that's been a problem for years in America, and it's a whole different issue that we could talk about. Okay, here's another one. Uh, how are people sorting out what tariffs were before any changes this year and where they are today? when I have suppliers talking to me, they discuss the whole tariff percent as if there weren't any tariffs ever before. How do you suggest we find the before and after difference? Wow, that is a great question. Um, because I have because acts typically come out and replace the earlier tariff, right? Um, it kind of gives a reset. However, on the government websites, if you really wanted to do this and check, you could check the earlier bills that were passed into acts, right? And you could see those old government documentation. Or you could probably network with folks like myself that have written it down or taken it and said, okay, here's what the tariff was, here's what the new tariff is, and just talk to peers. And if anybody else has answers they want to jump in with, I'm totally okay with that. Um, but that would be my suggestion. Or you could go back on my posts. Go back on K2 Sourcing's LinkedIn posts. You'll see all kinds of stuff out there. I'm just kidding. That would be a slow way to do it. But I like that. And Amy, what I think I'm going to do is I'm going to download some of those charts that I've downloaded from the past and make sure that I see if I have some old ones. But if not, get some baselines, right?
So thanks so much for everyone's time today, and hopefully we'll be seeing you soon.
Thanks, Melissa. Thanks, everyone. Bye
Thanks,
now.
Matt.